You're watching Portfolio Watch. Managing your own portfolio has possibly never been harder, with the JSE experiencing its fair share of companies with skeletons from Pembury to AO to Tongaat. Is it time to invest in exchange-traded funds? And if so, how do you separate the wheat from the chaff? To find out, I'm joined by Chris Rule, who is the Head of Products and Client Solutions at Coreshares, and Mike Brown, Managing Director at ETFsa.co.za. Mike, thanks so much for your time, and also Chris. So for investors that are looking to diversify their portfolio, making use of exchange-traded funds, which ones should they be looking at, and why? Mike, let's begin with you.
Well, exchange-traded funds give you access to all sorts of different asset classes. So you can buy equities, you can buy local or foreign equities, you can buy bonds, you can buy currencies, you can buy commodities. So there's different ETFs for different types of investment exposure. But if you're looking for a general ETF, most people buy something like a world fund or a USA fund. Or if you're looking at South Africa, you buy a top 40 fund. And the advantage of that is you're actually buying a portfolio. You buy one ETF, which is one share, and you now own a portfolio of, in South Africa, 40 different ETFs that make up the top 40 index, or 500 companies that make up the S&P 500, the top 500 shares in America. So that's a big advantage of ETFs. It gives you access to a portfolio with a single transaction.
Right, because ETFs have done well in the past 6 months, being helped by the performance of the JSE. But I mean, you're looking at around 105 or so products to choose from. If you're watching this and wondering where do you go, as Mike did describe the various asset classes that you could choose, what would be your top picks?
Yeah, sure. So as Mike said, the beauty of an ETF is you're buying one instrument, but you're getting exposure to a portfolio. So just going and buying an ETF in the first instance is a step in the right direction, we believe, as opposed to buying a single share. You mentioned some of the landmines on the JSE in the last year or so. So it really depends on your clients or your particular objective. As Mike said, if you're looking to get global exposure, then there are a number of world exposures that you can get on the JSE, and it's simple. You're transacting in rands, etc., and you're getting the right exposure. If you're looking for local equity, if you've got a long time horizon, say north of 10 years, there's a number of local equity. Mike mentioned the top 40s. We run a top 50, which has gathered a lot of traction recently. In fact, at the Salter Awards, it won a few awards, which is the ETF Awards. And investors are enjoying that because it gives you exposure to the 50 largest shares on the JSE. But back to the point of diversification, it caps the largest share at 10%. So in terms of vanilla, low-cost ETF starting point, we think our top 50 fund for local investors is actually is a great starting point.
So what happens to that fund now when Naspers unbundles its crown jewels into process and goes into Amsterdam? How does that composition change?
Yeah, so it's actually quite complicated. We're still waiting on some votes from the AGM at Naspers to understand exactly how the unbundling is going to work. But because that fund capped Naspers at 10%, your exposure should stay quite similar, because Naspers is such a huge component of our market. Depending which uncapped index you look at, it's between 15 and 25%. So it would probably be less impacted in a fund that has already capped it, like our fund. But in the top 40 funds of this world, that will make a large impact. I'm not sure if Mike has any further insights on.
Yes, Naspers is going to be interesting, but you'll still have an investment in Naspers, which will own 75% of the offshore company, but you'll also have a little investment in the offshore company. So in the end, most investors won't be particularly affected in terms of the exposure to the index if you've got a total market cap exposure. But if you've got a capped exposure, like with this top 50, where there's no more than 10% in any one single company, that takes away some of that risk, because Naspers it's nice to be in, but it's volatile as anything. You can go anywhere tomorrow. So by taking the volatility away, that often is a good thing for long-term investment strategies.
I see that there has been an uptick in global ETF products in the past recent while, and I just want to understand what that is a function of. Is it a function of soured sentiment towards local ETFs, or is it a function of just the fact that there's better returns to be had elsewhere? And I know you guys are part of this party.
Yeah, sure. So, I mean, the big wave of global ETFs is actually a function of a regulatory change. That change allowed local collective investment scheme managers, such as Coreshares, to issue global ETFs off their local license, essentially. And so that's when you saw a lot of global ETFs coming to the market. Previous to that, Deutsche Bank almost had a monopoly on global ETFs in our market. So, it's great. It's actually been a great evolution in our regulatory environment so that investors have far more choice, and we've seen the pricing of those ETFs drop as a function of that, and the choice is far wider. So it's generally been a good thing. I think as a fund buyer, someone like Mike would certainly have enjoyed the regulatory change that's kind of pushed the global ETFs.
No, certainly it's garnered quite a lot of interest, I do see. But like, I just want to know, many of the investors talk about the fact that if you're looking to really get returns, your portfolio should be skewed more to offshore because the local economy is in such a tough spot. And should you be thinking about the ETFs that you choose in your portfolio in a similar light, whereby you bag perhaps more ETFs that are exposed to global markets than those that are exposed to the top 40?
Yes, I think certainly when you're looking at a portfolio stance, having exposure offshore is very useful, because now you're in international markets, you're getting automatic hedging against rand depreciation, because if the rand falls, the value of your international portfolio goes up immediately. So from a portfolio point of view, managing risk, managing exposure, any international exposure is great. ETFs are by far the most cost effective and transparent and liquid way of getting that type of exposure. And so, as Chris said, when the regulations made it possible for you to list global ETFs on the JSE as international companies, just like companies like Richemont and so had got JSE listings as international companies. Now we've got ETFs registered as international companies. Now you don't need a foreign exchange control approval and all the rest to buy those companies. So you're getting global exposure through ETFs you can buy in the JSE. The choices got bigger, and therefore there's more competition. We'd like to see more. Typically when we're looking at portfolios, we're often saying, let's take a year or two view in the future, and then you're looking at how do you get exposure to places like China or India, or to high growth areas like the fourth industrial revolution or things like that. How do you get those themed approaches? And we're not getting a lot of that sort of product available in South Africa, whereas of course those ETFs are readily available globally. So I'd like to see the local issuers becoming a little bit more let's say far thinking, or a little bit more innovative in some of the products that they make available.
All right, so it's not a function of the local guys not being allowed to issue those kind of products. It's just you're not at that level of thinking as yet. Perhaps as Coreshares you can weigh in.
Yeah, sure. Look, when we look to bring products, we look to bring products with mass appeal. And so that's why you see a lot of world funds, you see lots of US funds, you see lots of now tech funds coming into the market. We do have a niche global fund, a global dividend aristocrats, which was one of the first smart beta global ETFs in the market. So I think it will come. The ETF market globally has absolutely expanded at a rate beyond comprehension. In South Africa, less so. And so I think the issuers in South Africa are tentative to launch more and more product without sufficient business case that these can actually be large, scalable ETFs. And that's really the challenge. Is if you launch the next let's say Asia ex-Japan, overweight Southeast Asia, because that's how specific it gets globally. Can you raise sufficient capital for it to make sense from a business case perspective? But I think on the global ETFs, what's fantastic is that, less about having a bearish sentiment on South Africa. As South Africans, we have so much exposure to our own country. All investors do. It's known as a home bias. So, if you live in an apartment that say you own, or you own your own business, you are inherently exposed to South Africa. So having global ETFs on the JSE just gives you easy access to diversify your holistic portfolio, looking at the big picture and diversifying it more than necessarily making a view of, that's our standpoint, is a diversification push,
Understood. Mining shares have had a lot, or received a lot of love so far this year, amongst the top performers. And I'm just interested in whether this is an opportunity for one perhaps to look into buying some of the ETFs that track the underlying commodity prices. And also something like ABSA's Platinum ETF. I do understand in your research that you say it hasn't been that popular. I'm wondering why.
Well, commodity ETFs are very interesting, because here you're buying a share that gives you direct access to bullion. And South Africans aren't allowed to hold gold bullion, because otherwise we'd all be digging in our backyard and trying to find some gold bars. So, but you can buy gold bullion in the form of an ETF, and you're then getting direct access to the commodity. So it's quite clear, and in recent times, that buying rhodium and palladium, very rare type of minerals that come out of platinum group metals, has been very successful. If you'd bought the rhodium ETF, you'd have made more than 100% per annum return each year for the last 3 years. So it's been incredibly successful. But rhodium and palladium are quite scarce in terms of the amount that comes out of every ton of, say, platinum group metals, whereas platinum is 90% of the ore you put out of the ground from a platinum mine is platinum, and the much lesser extent is palladium and rhodium. So they've got the scarcity factor. Can platinum be as successful because it's not as scarce as the other two metals? That's something you've got to take into account. You've also got to take into account that platinum's been used for many years as an exhaust catalyst in cars, and now there's lots of platinum being recovered because your exhaust packs up, but your platinum doesn't. The platinum carries on forever. So you're getting secondary recovery from those metals, whereas palladium hasn't been used for as long in exhaust catalysts. It's more efficient, but it's always been a little bit more expensive until more recently. And so there's those sort of issues to take into account. But getting exposure to global to commodity markets globally, which is something that we couldn't do in South Africa unless you took money offshore. But being able to do that in South Africa is very interesting. In terms of mining shares, you can buy the RESI index, which is Satrix as a resources index. But it's very interesting to look at global mining companies, which now you're not only buying, you're buying sort of oil companies, and you're buying big, something like BHP Billiton, which is a South African company, but it's originally, but they're a global mining company. Now, we don't have ETFs in South Africa that give you exposure to global mining companies. Now, that's the sort of thing, when I'm saying let's look at some innovation, that would be nice to see, that I could buy an ETF in South Africa that gave me exposure to Canadian and American and Russian and Chinese mining companies.
And just final words from you, Chris, in terms of the rest of the year, what is the ETF space looking like?
So I think we've seen a lot of product development, contrary to Mike's encouragement for more global strategies. But there really has been a lot. So what we're actually seeing is ETF issuers focusing on various value propositions so that they can, their clients can better understand them. So education around how you buy an ETF and what's its use case and how should one use it in a portfolio, I think is more important than us iterating on our product set. So our big focus going forward, and you're seeing it across a lot of ETF issuers, is educating investors and bringing them along and showing them the benefits of investing in ETFs.
Well, gentlemen, thank you so much for your time. We will leave it there. Thanks to my guests, Chris Rule, Head of Products and Client Solutions at Coreshares, and Mike Brown, Managing Director of ETFSA.co.za, for their input in tonight's program. Remember to email your questions to portfoliowatch@abn360.com and your tweets to #PortfolioWatch. Until next week, it's bye for now.